Hi everyone, and welcome back to the channel. When it comes to investment planning, deciding how to allocate your assets might be the single most important decision you'll make. But with so many options, selecting the right investments can feel overwhelming. And how do you combine them into a well-diversified portfolio that balances growth, risk, and any preferences you have, such as sustainability? In this investment series consisting of 4 videos, that's what we're going to try and answer. Taking an approach that's backed by some of the world's leading financial academics, we'll walk you through what you need to know to build a portfolio for your individual needs and objectives. Hi, I'm Jim Smith, Senior Financial Planner here at Pacific Wealth. We specialise in helping new migrants and returning Kiwis navigate the intricacies of cross-border financial planning to help you make the most of your new life in New Zealand. In this 3rd video of our investment series, we're going to be looking at growth and defensive assets and how we can use our understanding of risk factors from the previous video to build portfolios to suit the needs of individual investors. In the first video, we went through the major financial markets and identified the investments that are suitable for individual investors. Then in the second video, we introduced the concept of systemic risk factors, being equity risk for shares and term and credit risk for fixed interest, that provide the prospect of an additional return premium. We also identified some other risk factors that increase the uncertainty of return but don't come with an additional return premium. This way of looking at investments helps us to determine what risk we want to expose ourselves to more efficiently design portfolios. This table lists the main asset classes that we discussed in the first video and their risk factors that we discussed in the second. To help simplify things, we're going to group the riskier investments together and call them growth assets, and the assets that are normally safer and more predictable as defensive assets. The decision of what proportion of the investment assets should be allocated between growth and defensive is arguably the single most important decision and has the biggest impact on the overall risk and return of your portfolio. The more growth assets you have, the greater the potential returns, but the higher amount of risk. As explained in the first video of our investment series, our growth assets for individual investors should be publicly listed on recognised stock exchanges, which provides price transparency and ease of trading. Public investments can represent all the major elements of the global economy, including 23 developed and 24 emerging markets around the world. The starting position before making any adjustments to suit your specific situation, or if you wish to introduce a home country bias, is to allocate your capital based upon the size of each market, which is illustrated in this diagram. If you allocate your growth assets in this way, you are in effect buying a small slice of the global market and ensuring your portfolio is well diversified by company, sector and geographical region. Investors in most countries normally incorporate some level of home country bias in their portfolios. For a New Zealand investor, that means investing more in New Zealand companies than the actual size of the market. If we were to add up all the companies listed on the New Zealand Stock Exchange, this would only come to around 0.1% of the global market. This means that based upon the size of each market, the starting position with no home country bias, you would only invest around 0.1% of your growth assets in the shares of New Zealand companies. Now, when you consider the impact of a 0.1% allocation, this ends up being just a rounding error at the portfolio level and would have little to no impact on the risk of return. But there are 2 reasons to consider increasing the allocation to New Zealand shares to a more meaningful level. The first is that New Zealand resident investors can access something called imputation credits. These refer to attaining a credit for the tax a company pays on its profits and using this credit to offset against your personal New Zealand tax liabilities. This therefore represents an additional return that only New Zealand resident investors can access and that you won't receive from investing in other markets. The second reason is that New Zealand companies are based in New Zealand dollars. An investor living in New Zealand will do most of their spending in New Zealand dollars, and holding New Zealand shares can mean not having to worry about foreign currency conversions and fluctuations. If you look at the asset allocations of the 100 billion plus invested in KiwiSaver funds, an example, which are run by professional money managers and designed for New Zealand investors, you see that they tend to allocate around 25% of their growth assets to New Zealand and Australian shares. Assuming half of this is allocated to New Zealand, this will represent a 12.5% allocation, which ends up being an overweight position of 125 times the size of the New Zealand market. Whilst New Zealand is an open economy and benefits from a relatively young demographic, it is subject to its own individual risks. This includes being in an earthquake zone and having an agricultural economy which could be affected by a natural disaster or an outbreak of some disease. What is the right home country bias for you? Well, this depends on your situation. If you happen to have a fair amount of wealth tied up in New Zealand property or private business, you could easily decide that it doesn't make sense to increase your exposure to the New Zealand economy further and select a 0% weighting to New Zealand shares in your growth allocation, passing up the available tax benefits in favour of better diversification. If you don't want to pass up the tax benefits and like the idea of investing locally and supporting New Zealand businesses, opting for an allocation of less than 5% probably doesn't make much sense, as it would have little to no impact at the portfolio level. Hence, if you want to invest in New Zealand shares, you could aim for something in the range of 5 to 15% of your growth assets. Once you've decided on your level of home country bias, there isn't much benefit to over or under allocate to the other economies or regions, and so the balance of your growth assets should be allocated proportionally to the global portfolio. Aside from any home country bias you intentionally introduce, following this method will ensure your growth assets are well diversified. However, it will still be exposed to global stock market movements, which as a group can be volatile and go up and down in value. Hence, it's important to consider how much you should allocate to defensive assets, which we will look at next. To balance out the risk of growth assets, it is normally sensible to allocate some of your investment assets to defensive assets. Defensive assets are mainly fixed interest bonds issued by governments like the New Zealand or the US, as well as private companies. Because we want our fixed interest bonds to have defensive-like qualities, we should limit the universe to mainly short and medium-term bonds. In technical terms, this limits the amount of term risk that we are exposed to so that our bond values are not overly sensitive to changes in interest rates, which we discussed in the previous video. We should also only select issuers of bonds that have an investment-grade credit rating or above, so that the probability of default is much lower. These design rules should help our defensive assets provide a buffer to movements in our growth assets. At certain times, it can be tempting to relax the credit standards and go searching for additional return yield. However, if you do this, your bonds could start to correlate with equities when markets become stressed. Within this process, we consciously accept a slightly lower return in this bucket to gain the defensive-like qualities. If you want higher returns, it is usually better to increase the allocation to growth assets, where you generally get a better risk-return trade-off, rather than go hunting for additional return, such as taking on additional term or credit risk. Within the defensive bucket, we allocate to New Zealand and international bonds to provide an overall spread of risk. You may wish to introduce a small home country bias, but otherwise the majority of the defensive assets should be held in international bonds, which should be hedged back to the New Zealand dollar to remove unwanted exchange rate movements. The amount you choose to invest in growth and defensive assets is arguably the biggest single decision you will make as an investor and has the largest impact on the risk and return of your portfolio. So it's important to consider your individual needs and goals carefully to ensure you get this part right. In this video, we have described the general portfolio design process and how assets should be allocated between growth and defensive assets. In our final video, we look at how to implement this strategy and include any investment preferences you may have, such as sustainability. If you're interested to learn more about financial retirement planning issues that international migrants need to know when moving to New Zealand, we've also created other videos that you can explore on our YouTube channel. You can also visit our website, www.pacificwealth.co.nz, and if you have any questions, please feel free to reach out to myself or a member of the team. Thank you for watching and see you in the next video.